So welcome all of you. Thank you so much for being here at our next Women in Sustainable Finance International webinar today with Emily Forsyth Davies of Aurum. And Aurum is one of the sponsors of our organization. We're very grateful because they help us to fulfill our mission and to complete our goals, what we would like to do with our organization. Today, Emily is going to talk about greenwashing and the green box. She's talking about her experience and also what she sees in the industry, things you can look at and also be careful with. What we have discussed before, Emily is very, very happy if this is going to be interactive. So please feel free to pose your questions whenever you have the question. You can put on your camera, you can unmute yourself, you can raise your hand and I will give you the word, or if you feel comfortable, you can put a question in the chat and then I will make sure that I pose the question to Emily for you if that's something you feel comfortable with. The goal is that we're going to finish by 6 p.m. our time, which is going to be 5 p.m. Emily's time because she's based in London. The presentation will take about 45 minutes, but as we said, please feel free to be interactive and to post all your questions as we go along to make it interactive. Emily, I'm more than happy this is your audience today. We are very keen to hear what you have to say on green box and greenwashing. The floor is all yours. Thank you for being here.
Perfect. Thanks very much, Edith. So I'm just going to share my screen. So if you can't see the screen, please put your hand up and we will do something to make sure that you can now see the screen. Perfect. So what we're going to talk about today is the definition and origins of greenwashing. Why is greenwashing such an issue now? The AUM flows that are associated with sustainability, how regulators have tried to intervene with greenwashing. So as I'm sure a lot of the European audience today will be very aware of the Sustainable Finance Disclosure Regulation and the impacts of that. Then what we're going to talk about is very practical. So really talking about what to look for in an ESG manager and how to make sure that you're minimizing your chances and how to avoid being greenwashed. Specifically with a climate focus and other focuses as well. Hedge fund challenges. So I work for Aurum, which is a fund of funds manager. I'm going to talk about our approach as well. So the parent company of Aurum and the approach they have to impact. And then we'll just talk through briefly the conclusion. And obviously, as I've said already, and Edith said, please feel free to ask questions as we go along. I'm more than happy for this to be an interactive discussion. I think we've all been to enough Zoom webinars where there's just one person talking for 45 minutes. And sometimes that works well, and sometimes people just sort of fall asleep. So very much encouraging. If you do have any questions, just let me know. Okay, so what is greenwashing? So greenwashing is the process of conveying a false impression or providing misleading information about how a company's products are more environmentally sound than actually they are in reality. So this phrase was coined in the 1980s, as I said, to describe what really are outrageous corporate environmental claims. This is typified by what Chevron did. They were, the fossil fuel company, they were required to spend money on conservation efforts. They spent, I think, about $15,000 in the late 80s. And then they actually spent $2 million advertising what they'd done. So they're really spending a lot more on advertising that you're doing good things than actually doing good things. And why is this such an issue? So there was a poll in 2015 that found about 66% of global consumers, so 2/3 of people, were prepared to pay more for environmentally sustainable products. And that actually rises when you talk about millennials, that rises to about 72%. So younger people are prepared to spend more on environmentally sustainable products. And actually they're really bothered about where their products come from. The amount of adverts I get for environmentally sustainable leggings is enormous. So it's a really big thing within the cohort that actually this is something that's really important and is driving consumer choices. And that was really shown when Deloitte did their most recent study of millennials and Generation Z. And the top concern that they had, so they were asked the question, which of these 3 issues are of the greatest concern to you? And climate change and protecting the environment, as you can see, was by far and away the biggest issue. And really we're starting to see more of a shift in this area. So more and more people are concerned about the environment. Therefore, the amount of assets moving into these green products has grown quite significantly in the last few years. And if we just look at this slide, it shows that the amount of growth in sustainable funds assets has increased by about 4 times since the end of 2016. And the most optimistic estimates suggest that about 60% of mutual fund assets will be managed through a sustainability lens by 2025. And when I say a sustainability lens, I don't necessarily mean an exclusion strategy, so not investing in fossil fuels or not investing in tobacco, for example, but really making sure that ESG factors, so environmental, social and governance factors, looking at things like whistleblowing policies, human rights policies, those kind of things will be incorporated into an investment process. Now, why are asset managers so keen on this? So fees are higher on average for sustainable funds. And if you compare the average US mutual fund, which is what this data is based on, it's about 43% higher for the sustainable fund than for an exchange traded fund. So a really big fee gap there. And that's obviously why it's so popular. So
Emily, may I ask a question?
Of course.
Do you know the reason of this fee gap?
Of the higher fees, I think just because people are willing to pay more, as we talked about on the first slide, willing to pay more for a sustainable product than they are for a normal product. And actually, there's not necessarily a reason why it should be more expensive, but it is just because there is the demand there, and they can charge higher fees. So that's clearly making it a more profitable business activity.
Thank you.
So what's wrong with sustainable funds? So in theory, nothing. It's a great way for you to express your values and in order to not, cause damage to the world. But in reality, there are 3 key challenges for investors. So the first challenge, as you can see, is data. So this is data from 2 perspectives. So data from companies, issuers of securities, issuers of debt. What data are they providing, and is it useful? So a great example I have is one of my friends works for an activist investment manager in the States, and they were doing some work on a very large, well-known soft drinks company. And when they were looking at the data that had been provided by the data company they use, they'd received high marks for their water usage. And my friend looked at this and she said, it can't be right. Surely, we all know that they're using a lot of water. So she spoke to the data company and said, so where's this actually come from? This fantastic use of water, very low, absolutely fine, nothing to worry about. And they said, actually, the company ticked NA when they were filling out the survey and the questionnaire. And so they'd just given them the highest marks. So clearly not optimal at all. How many people are actually going to the extent of questioning the data providers and checking the data sources when they look inconsistent with what you would expect? So clearly that's a big issue. The second issue is how the data is being interpreted. So we have a number of different ratings agencies for ESG criteria, and they're all taking a very different approach to looking at the data from the issuers and deciding how to rate a company. Now, the key example here that people talk about a lot is Tesla. So Tesla, one ratings agency gives a very high mark to, because obviously moving to electric vehicles, reducing fossil fuels, reducing CO2 in the atmosphere, and also nitric oxide and so on and so forth in towns and cities. Great. But on the flip side, what are the components required for an electric car? So lithium-ion batteries are very detrimental to the environment when they're mining for the components. So mining is currently done in the Democratic Republic of Congo, significant issues there with human rights and also environmental degradation. And then the alternative to taking it from there is deep sea mining. Now, I don't know if there's anybody here who has read a lot about deep sea mining, but it can be very, very environmentally damaging. These are very, very sensitive ecosystems, and they may not recover after the mining has happened. So very sensitive, unique ecosystems, not really explored by humans. And instead of mining in the Democratic Republic of Congo, people are now saying, actually, maybe we should do deep sea mining instead. So that's why then the Tesla has this negative rating from one ratings agency. So clearly a lack of consistency in data being provided by issuers, and then a lack of consistency in data processing. So the second point is impact. Now, it's extremely hard to measure impact. for a company. Really, really hard to ascertain. And then I'm sure, like the rest of you, I've tried to make a number of environmentally sustainable choices in my life. And you always find that there is some kind of negative externality without that. So probably the one I see the most is people talking about plastic bags. So obviously in the United Kingdom, we now have a charge on plastic bag usage. So you have to pay for any plastic bag that's given to you. It significantly reduced the amount of plastic bags. Fantastic. But on the flip side, what are people using instead of plastic bags? Well, probably those cotton tote bags. And actually the energy usage and the amount of time it takes to produce a cotton bag relative to a plastic bag is pretty significant. So I've seen different estimates ranging from about 200 to 2,000 times. And so it's not necessarily clear cut that one is better than the other when you look at all of the externalities involved. So if we're talking just about that one plastic bag product, how are you supposed to do that with a company? So every single positive move that a company takes can also have a negative move as well. And really, there was quite a big study done by UTIL looking at the SDG impact of different funds. So they looked at 281 US domiciled mutual funds and compared that to the broad mutual fund universe. And they used a range of -100 to 100 to measure the impact of these funds relative to the United Nations Sustainable Development Goals. And what they found was that the average sustainable fund got a 3, so +3. And the average normal fund or the wider fund universe only got 1 out of 100. So the difference between the two of them was very, very small. And actually, you're not necessarily able to show that your allocations have that big of an impact. So although you're making these sustainable choices, actually how they're implemented isn't necessarily having the impact relative to if you just invested in a more standard path. And the third point is investment allocation. So as we're all aware, probably, technology has been a really, really big factor within investing. So it's been really, really popular. And so ESG funds are generally very overweight to technology, or so you would think. Actually, based on this same set of 281 US mutual funds versus the wider mutual fund area, they have about 18% allocation to technology. The normal mutual funds have a 16% allocation to software and technology. Similarly, when we look at oil and gas allocations, the sustainable bucket have a 1% allocation versus a 2% allocation for the standard bucket. So although it clearly is on the more sustainable side, it's actually only a very small shift in allocation. And also, if we start to see technology stocks falling out of favor, it's unclear as to what exactly ESG funds will hold. So it's a very big issue of what will happen if we see a big sell-off in tech stocks and what will happen in the future to this investment allocation. And what I found really interesting was looking, there was a really big report run by ShareAction, which is a group in the UK, who looked at the 75 largest US investment managers and how they performed on a number of different ESG metrics. And what they found was that there was really no correlation between a manager's overall performance on responsible investment and the breadth of their ESG products. So once again, that shows this disconnect between advertising versus actual influence and actual impact. Okay, so what can we do about greenwashing? So the EU's first step in their EU's action plan for financing sustainable growth was to put the Sustainable Finance Disclosure Regulation, or SFDR, in place. Now, I don't know exactly who's on the call today, so if you do know a lot about SFDR, please feel free to chime in. But the aim of SFDR is to increase transparency by imposing sustainability disclosure requirements. Now, who does it apply to? So investment management firms at both the product and manager level, and the sustainability disclosure requirements only currently apply to equities. So managers have to classify their funds as either not being sustainable, being light green sustainable, or dark green sustainable. And it's been really, really impactful doing this because it's meant that everyone has to be able to justify saying that their fund is sustainable, basically. Now, the EU is a real trailblazer in setting this regulation to prevent greenwashing. There haven't been any other regulators who come out with anything as of yet. The SEC has taken some action with regards to what they think are misleading claims, but they are more generally misleading rather than specifically to do with a sustainability lens. And current expectations are that they will start to develop their own regulatory response and legislation in due course, and that also SFDR will encapsulate more indicators across different asset classes. So as I mentioned, it's very equity focused at the moment, but in the future, the indicators will be expanded out.
Emily, sorry to interrupt, but I have another question, which I actually have been asking myself for quite some time. If I'm not mistaken, please correct me if I'm wrong, the SFDR puts more focus on environmental issues and less focus on social and governance issues, although it's as I understood, a full sustainable regulation. Can you please elaborate on that? Is that correct?
Yeah, so more of a focus on environmental issues, as that's where you're seeing the most focus happening at the moment, but expected to expand out across social issues as well. I think governance is already quite well covered, but yes, very much environmental focused, and specifically to do with climate change. One thing that's really good about SFDR is it does actually have teeth. So as far as legislation goes, I'm sure we've all seen legislative initiatives that people are announced but don't actually have backing behind them, but there can actually be punitive measures for managers who are found to have misled investors. So actually it is, although it is really a starting point, it does have teeth, and it is indicative that the future path of regulation will help to continue driving innovation.
Thank you, Emily.
Okay. So clearly we've talked about greenwashing. We've talked about the fact that it's an issue, why it's an issue. So what can you do to try and avoid being greenwashed? Nobody wants to be greenwashed, so what can we actually do to avoid it? So when you're looking at an ESG manager, very, very important, as we've said, not to be focusing on what they're saying about themselves, but actually what they're achieving and what their impact actually is. So the first thing, look at their approach to responsible investment. So assessment of investments on society are included as part of the ongoing investment assessment. So this should include key themes such as we've spoken, carbon usage, biodiversity impacts, and human rights. So often there can be a distinction between E and S factors, but actually a good environmental initiative should also be positive for the society that it's impacting, because that will make it more successful in the long run. So there's been a lot of talk about environmental justice, Indigenous rights, and making sure that the community that you're undertaking these environmental initiatives in are fully involved and fully on board with what you're doing. And that's the way to make something very successful. And not only making this assessment, but also including it as part of your investment case. So it can't be just assessed and then left in a drawer that no one ever looks at. It really needs to be part of the investment case and the investment discussion as part of making a decision as to whether you're going to invest or not. And it really is making sure that it is part of investment. It's not a separate thing. Responsible investment is investment, and you really want a manager who really believes that and is undertaking that in their process. The second point is accountability. So accountability for responsible investment should be at both board and senior management levels. So you should have technical experts within the business in responsible investment and ESG investing, but it shouldn't just rest with them. They shouldn't be people who are kind of left alone on a desk that no one ever talks to, locked in a room somewhere. They need to be involved in the investment decision making, and the investment decision making and the impact on the wider society shouldn't rest with them. It should rest further up the food chain with both board and senior managers, and they really need to understand why this is important, and also to be fully aware of the impact that they could be having. And that means that reporting structures should be clear and transparent. So it should be obvious that if you do have a siloed responsible investment team, how do they feed into the process, and how do they feed information across the business? So the third point is training. So mandatory training should be on kind of key topical issues for all relevant staff, including board members. This should be occurring regularly and leveraging both internal and external expertise. So when I say external expertise, what do I mean? So I'm talking about making sure that everyone's aware of the wider context in society. So when you're talking about biodiversity and climate change, why do these things really matter? Making sure that we've got the real world picture and that we fully understand why this is important and what knock-on impacts we could be having. And it should also cover all relevant asset classes. So as I've mentioned already, there's a real focus on equity because actually that's normally the easiest asset class to do these things with. But actually, you can do these things definitely with fixed income and to an extent with alternatives. So really, it's important that people understand the wide range and the wide impacts that this can have, and training is really key. So next point is financial incentives. So responsible investment and ESG considerations are included in remuneration policies. So I've definitely heard arguments here where people have said, well, you know, we're looking to have long-term sustainable value to the portfolio. So obviously it is already included in financial incentives. Well, no, because if you don't make it clear and transparent that responsible investment is important and will be included, then it doesn't really focus the mind. Things get left in a drawer, things aren't really taken into account, and therefore, you know, there's sort of no point having it unless it's going to actually influence people and really, as I said, focus the mind. And then responsible investment objectives should be linked to real world impact. So once again, even if you produce the best assessment in the world, but then leave it in a drawer, it's not going to influence anything. So we should really make sure that it's based on the real world impact. I can see there's a hand up, Edith.
Exactly, Emily. Someone has raised their hand. So feel free to, however you feel comfortable, you're exactly. Please go ahead and post your question.
Thank you very much, and thank you, Emily, for this presentation. I have a question. Since we are at what we are looking for an ESG manager, just had a question about what do you think about also there is a need of changing the mindset of an asset manager in terms of financial performance when we talk about applying kind of climate actions or implementing actions that have to have a real impact in terms of environment or social, but that shouldn't be subject to short-term profitability, but should be considered as a prerequisite to the continuation of business and so on. Do you think this kind of mindset is not this long-term vision? Is it it's not that mainstream, but I would like to have your view on that.
So I would say 5 years ago, I hadn't really met anybody who was thinking like that. But in the recent last couple of years, definitely, you know, I've heard more and more managers say things like, my grandchildren have told me I need to do this, or, you know, I'm worried about the future for my family. And so I think that mindset is becoming more mainstream. I think one thing that was actually really helpful, dare I say, about the pandemic was that ESG stocks actually did quite well. So those with the better ESG characteristics during the crash in March 2020 actually did quite well. And I think there'd been a lot of talk up until that point saying ESG is a fad. You know, it's done well, but that's because we've got, you know, hippies putting their money into this, and actually that's what's driven performance. And actually, no, when you're looking at ESG criteria, so if we talk about the soft drinks company again, actually water usage is a really big issue. Where they are positioned in the world, there are water shortages. And if they're able to run their business with less water, with being less resource intensive, that will benefit their business over the longer term. But there is, as you say, there is short-termism, but I think you are starting to see a shift there. And actually, businesses that do have better sustainability criteria, that do treat their staff better, so have better people policies in place, are outperforming. And really, March 2020 was the first time we'd seen a squeeze during this kind of recent time of responsible investment being much more mainstream. And so although there are still doubters, there are a lot more people now who are comfortable with it and are saying, actually, it is the right thing to do. And actually, it is quite a profitable thing to do. So within the hedge fund industry, which is where I work, people are starting to look for alpha signals, so ways of outperforming the market related to ESG. And there definitely is alpha to be made. Okay.
Thanks.
Perfect. Okay, so the next point is about voting policies and transparency. So clearly this is only for equities, but I think it is an important point because voting is obviously the key way that most investors express their views. So a lot of managers say we don't really need a voting policy because, you know, we vote in a specific way and we always try and do our best, but actually it's really important that they outline their positions and commitments on key ESG topics up front. And that's because without doing that, it's really hard for people to hold them to account and to say, actually, we thought you were going to vote this way, but you voted that way. And please, can you tell us why? And the other thing is you've seen an increased number of shareholder resolutions coming through. Now, as I've mentioned, one of my friends works for a US activist investor, and she's put through a number of shareholder resolutions this year, primarily about diversity and inclusion initiatives, and also about, as I've mentioned, water and sustainability. And actually, asset managers should be supporting those if they are the best things for the business. And instead of just voting with management, who obviously frequently take positions opposing shareholder resolutions, actually, if they want to vote against the shareholder resolution, they need to have strong rationale as to why, not just to say, oh, well, management don't like it, so we're just going to vote alongside management. Voting decisions and rationale should be published as soon as possible after meetings are held in a publicly available format. So just to make sure that people can check their voting decisions and can ensure that they voted as they expected them to. And then once again, significant votes for key resolutions should be pre-declared ahead of the meeting. So often you can find the larger asset managers, if they pre-declare that they're going to vote one specific way, so vote in favour of a shareholder resolution, that can have a positive impact on how other people vote and can be a really important driver of change. So it is important to ensure that if you are going to support a shareholder resolution, you make it very clear why you're going to do it and that you're going to do it in advance so other people can take comfort from that and also understand your rationale for doing so.
Emily, thank you so much, because I think this is a very important topic. And I realize that sustainability, of course, is also a personal process or in line with company or foundation goals and objectives. And therefore, I know we have, on the one side, of course, we had exclusion. That's how we started. A lot of church foundations do a lot of exclusion out of their values. But I would love to hear your view on what are the pros and cons of exclusion versus voting policy and engagement.
Sure. So I think exclusion can be really helpful, as you said, for churches, you know, who obviously don't want to invest in certain things. Charities also, you know, for example, if you were an anti-tobacco charity and you were found to have your pension scheme assets within it investing in tobacco, the key one in the UK is the Church of England were very critical of a short-term lender that charged very high rates called Wonga, and then they were found to have a small allocation to that within their portfolio. And that obviously is very, very bad publicity and also not what they wanted to be doing. You know, that's not the impact that the Church of England wanted to be having with its assets. So I think it's particularly useful if you have very strong views, because clearly you don't want to be funding specific companies and also reducing their cost of capital as well. That's not something that you would want to do as a personal aim. More generally, exclusion can cause issues with underperformance because you are excluding a sector of the market. And just if you think about that mathematically, you have fewer choices to make, therefore it is harder to outperform. ESG integration is generally shown to be additive value-wise, although clearly if you were having very strong views, you wouldn't necessarily exclude full sectors from your portfolio. However, by taking a view within the ESG space and saying, actually, I want to encourage companies that are improving through time, then you would be able to kind of be more value additive in that way. So if you were engaging with a company that perhaps was struggling with some specific aspects, it could be water usage, fossil fuel usage, perhaps some labor issues, then if you were able to engage with them, help them to come up with an action plan and set objectives, then you would expect their performance to significantly improve through time, and therefore the performance of the portfolio to do very well.
Thank you very much for this clear answer.
Okay. So that lovely segue there, Edith, brings us on to engagement transparency. So a lot of the time when you talk to an asset manager, they'll say, yeah, we've engaged with a lot of companies, we've really had great impact. And then you ask them for some case studies and you maybe get one or two, but actually it's really important that managers provide a complete list of companies they've engaged with during the reporting period. So generally every year or every 3 months, including key topics. So what have they been talking to them about? And the topics they've engaged with. So where have management shown that they're interested, and where has the investment manager been able to add value and to help the underlying company? So that's really important to have a list. Then some case studies. Now with case studies, sometimes you can find they're a bit vague. So it might just say, we engaged with them and we're going to continue to engage with them. I don't know, perhaps on something like cybersecurity. We've noticed their cybersecurity policy isn't great, so we're going to engage with them on it. We've had a meeting, we've had a couple of phone calls, we've given them some ideas. That's your case study. It's not really good enough. So they should include details of objectives. So we're going to be talking about cybersecurity. They're going to implement a new system, they're going to get a third-party audit, they're going to do various other things. What are the outcomes? So what have they actually done relative to the objectives? And what are the next steps? So if they don't take this action, what are you going to do? Are you going to divest? Are you going to give them more time? What does that timeline look like? And that's really important because there can sometimes be a reluctance to take action. And I'm not really one to take immediate action, but I think it should be very clear what the escalation points are and what the direction of travel is. Because if you have a company that's really dragging their heels, do you want to still be invested with them? If they're not taking this advice on board, they're not interested in improving their standards, then is that where you think your money is best placed? And then also their activity relating to collaborative initiatives. So that can be anything from being involved with the Principles for Responsible Investment, looking at the UN SDGs. Where are they really taking a thought leadership role and really collaborating with other investors in the market? So I've included a section about climate specifics because obviously climate change is the number one point that we're talking about. Now, this isn't to diminish any of the other points and other risks that are associated with environmental, social and governance, but clearly climate change, especially given COP26 at the moment, is very much top of the agenda. So the first thing to think about is portfolio decarbonization. So a huge number of managers, and I don't think I go a week without seeing another manager committing to net zero emissions across all AUM by 2050 at the latest. So how are they going to get there? So I've seen a lot of people announce net zero for their portfolios, but how are they going to get there? How are they going to make this big transition? Because it is going to be a big transition. There's no shying away from it. It's going to be difficult and people need to start thinking about how they're going to achieve it now. So obviously 2050 sounds a really long way away, and it is, to all intents and purposes, quite a lot of time. But this is really significant work that needs to be done. So we should be looking for things like interim targets set for 2030 and how they're going to be achieved. So what are they aiming to cut? Is it 20% of the portfolio's carbon footprint, 50%? How are they going to do that? And how are they going to leverage that up through time? And talking about scope 1, scope 2, and where feasible, scope 3 emissions and how those are being taken into account. So just to clarify, scope 1 emissions are all direct emissions that a company has. So that's normally things like company cars burning fossil fuels, and also gas being burnt to heat the building, or perhaps in some other buildings, coal, or so on and so forth. Scope 2 is all indirect emissions related to electricity. So That's electricity purchased and used not only within your own building, but also data centers are a very large source of electricity usage for most investment managers. And scope 3 is all other indirect emissions, so things like investment. So if you're investing into a company, you take on their emissions. Supply chain, so if you're looking at a manufacturing company, their supply chain and where their products are coming from. Processing of sold products, so what are you actually, what is the carbon footprint of the products you're selling, and how do you dispose of those products at the end of their useful life? So scope 3 is very much all encompassing. So you may have seen some businesses come out and say they're carbon neutral, they've offset. That's normally only scope 1 and scope 2 emissions, not normally scope 3, because it is very difficult with scope 3, as you have to look through to your supply chain and they have to be reporting all of their emissions. I see another question.
Yeah, it's me again. I have like a question regarding this portfolio decarbonization. What do you like mean by when you talk about portfolio decarbonization? Is it about like aligning a portfolio, like reallocating the assets to from brown or from high carbon intensive assets to like less carbon intensive assets? So it's just for me that type of like for an ESG manager that would like to have an impact. For me that there is a need to go beyond just maybe like reallocation and think about what does it mean in terms of impact in the real economy. So do you think this knowledge is like is this something known at the managers, the asset managers level, that portfolio decarbonization or alignment or reallocation doesn't mean impact in real economy?
So I think that's a great point. So I think portfolio decarbonization is quite a new subject. So I think there are very few managers out there who would be able to answer that question. But yeah, you're completely correct. Moving away from brown industries to green industries, great way to cut your portfolio emissions. Also looking at offsetting and how you can make an impact perhaps alongside the portfolio and investing. But clearly we've all seen those statistics that come out saying there's not enough land on earth to plant enough trees to offset all of the emissions we currently have. So it's going to need to be a combined effort between, first of all, lowering the impact of your portfolio, and then also thinking about how you can offset the impact that you can't lower. But once again, very early stages in this net zero emissions journey. And actually, I don't think there is an easy answer to that. So it is a great question because it's very difficult. And also I don't know if anyone has an answer of how they're going to get to net zero by 2050, but it's really about how people are setting objectives. How are they thinking about it and how are they approaching the problem? And are they actually thinking about it? Because it's quite easy to sign up to an initiative and get the publicity associated with it and not really have a plan. And you shouldn't really be giving credit to people who have done that. It should be, people who've signed up for 2050 and then they say over the next 5 years, we're going to remove, 10% of the fossil fuels in our portfolio. And that's really meaningful, but they're quite conscious that this is a continuous process. This isn't we make an announcement and we're fine. This is every year we need to be monitoring it. Every year we need to be managing it. And it needs to be continually under evaluation.
Thank you so much.
I totally agree. Thanks.
Thank you so much for being so active. It makes it lively. So we're very grateful for your input. We have 2 other people who have a question.
It's just getting a bit dark in here, Edith. Let me just go and put the light on.
Okay. And in the meantime, I can say, Graytel, I think you were first. So I'm very grateful if you could post your question. Sure. Emily being in shining light. Thank you.
Yeah, hi everybody. I work at UNEP in the climate finance unit. I don't have a question. I just have a reaction to the previous question and answer by Emily. So about the real the impact in the real economy of portfolio decarbonization. So I think the impact is there only if there's enough critical mass in terms of, 80% of the globe of the banks worldwide do this portfolio decarbonization. This is the only way in which it can really have an impact in the real economy and really bring emissions down. Because otherwise, I mean, you as a bank A, you decarbonize your portfolio, but then bank B does not do the same and continues to finance the same polluting, very brown industries. So there is no impact at all. In this context, is much better to do engagement, because with engagement you can actually convince your client to go green and have a real world impact. That's it.
Yeah, sorry, I'm just still talking here, but I totally agree with that. That's why I thought it was important for me also from a bank and financial institution perspective to understand that portfolio reallocation doesn't mean having an impact on the real economy unless it is collectively done. And I think it's something that should be like important to understand, to not lower ambitious actions.
Thank you very much. So thank you very much, Gretel, also for this very valuable add-on. Really grateful. Anna, please feel free to post your question.
Yes, thank you. I actually don't have a real question, but I wanted to get into the discussion because portfolio decarbonization is also a very big topic for us. I work for an asset manager, and I've researched different approaches that other asset managers have taken or have advertised, and I really wasn't satisfied with that. So I remember one asset manager, they wanted to short, so sell very high emission companies and thereby mathematically create a net zero portfolio. Or another asset manager wanted to buy carbon certificates and thereby neutralize the carbon exposure. But this really doesn't have any real impact in the real economy. So I think the best solution is to invest in companies who are right now brown but want to become green. This would not work with exclusion, so negative screening. You cannot exclude per se companies with a very high carbon emissions, because those companies you have to finance and you have to engage with to lower their emissions. I think this will be the strategy with the biggest real world impact.
Yeah, definitely. And I think that that value additive approach has been shown to really add value to portfolios as well. So you would have a real world impact, and you should also be outperforming the broader market in theory. Obviously past performance is no guide to the future. So I think the key thing there is that this is difficult and there are different answers coming out. Probably none of them are going to reach net zero by 2050, but at least it's starting people to think about innovation. How are they going to start taking the first steps? Just to come back to your point, Anna, about long short offsetting of carbon emissions, completely agree. I don't think that is the way at all that you should be reporting long and short positions. And I would say that actually short positions and long positions, when you're looking at things like weighted average carbon intensity, should be reported separately, because it's not right to offset them, but it's equally not right to add them together. So definitely in favor of reporting those data points separately. Okay.
Thank you very much, Anna, for bringing this up. Very valuable. If there are no other questions at this point in time, please, Emily, feel free to continue.
Sure. So the next thing is looking at the Task Force for Climate-Related Financial Disclosures and how they've approached this. So clearly still quite a new piece of legislation. and requiring comprehensive and detailed disclosure across the 4 pillars. So for those of you who aren't familiar, the 4 pillars are governance, strategy, which includes scenario analysis, risk management, and metrics and targets. So as I said, TCFD reporting, once again, and I know I've said the word quite a lot today, hard, difficult, challenging for most asset managers, but it's really about understanding the direction of travel. How are they approaching it now? What are they aiming to do in the future? And where are they focusing their energy? Because clearly no one has the right answer, but it's the people who that are approaching the problem and with the most sophisticated solutions who will have the best outcome.
Okay. Please continue, Emma.
Okay, thank you. And then thematic engagement. So as we talked about, clear and transparent engagement is very important. So this is about making sure that you are engaging on your specific targets, high impact sectors, so they're very brown sectors and topics that are very relevant. So probably less point talking about water usage to a company, a software company who don't really use a lot of water, providing clear timelines, expectations and escalations, and ensuring engagement activity is aligned with the goals of the Paris Agreement. And this sort of more broadly covers wider engagement, so engaging on things like biodiversity and also on things like human rights. It's really making sure that you are being very strategic in how you're doing this, and you're looking at the best impacts and the best case scenarios and how to achieve those. Okay, so we'll talk about the green box now. So obviously I've said I work for a fund of fund hedge fund manager, and I think we all know that hedge funds are known for their complexity and lack of transparency. The phrase a black box financial model is commonly used. It's very much a catch-all term used to describe a computer program that drives an investment strategy, transforming data into an investment strategy that will be value additive. So as we talked about, adding alpha to a portfolio. And on a similar vein, when hedge funds implement a responsible investment strategy, very limited transparency. And that gives rise to what we call a green box. We've got the black box and the green box. And this is because their legal structure and choice of jurisdiction means they have relatively few disclosure requirements. They often use high frequency trading strategies. And we talked about traditional asset reporting already. So weighted average carbon intensity is one of the key things that's reported on. Actually, that doesn't work if you're in a high frequency trading strategy, because what you're holding today will be very different to what you're holding in a few weeks' time. And they're not comparing apples with apples, basically. So any assessment of a hedge fund's ESG credentials needs to be very strategy specific. So from taking an exclusionary approach in a macro strategy hedge fund to activist positioning, so where are they choosing to take an activist position, or as we've talked about, choosing to short bag companies as part of a long short strategy. Now, clearly can't offset the carbon between them, but it is better to short a carbon intensive industry and go long a less carbon intensive industry if that's how you want to express your investment views. So in summary, assessment of ESG and hedge funds is difficult. And so it's important to think outside the box and look at alternative ways to have a positive impact. So I've just noticed we've got a few messages in the chat. Okay, great, thank you. So we will then talk about the approach of my employer's top level management company. So instead of taking a specific hedge fund ESG approach, we are an embedded impact business where donations are structured to proportionally increase with firm AUM, and donations are then made to selected environmental and humanitarian strategies. There are 2 embedded impact funds in addition, where donations are made from investment advisor fees, and that's meant that we've donated about 12 million to charitable causes. I realise we're starting to run out of time, so I'll just touch briefly on the causes that we've been supporting, or the management company have been supporting. Hope and Homes for Children, which is a charity that focuses on stopping orphanages and taking children out of orphanage situations, which can be very detrimental to their emotional and physical well-being, and making sure that there are policy changes in place to support children to stay with their families in future. So as you can see, 38 children will be taken out of this orphanage in Romania, and a number of children have already been supported to stay with their families. And then also influencing policy on the environmental side. So global wetlands are being destroyed more quickly than rainforests. And so it's really important to protect rivers and really work on policies to protect rivers. And the outcome of that, and this is where the impact is really important and is much easier to see when you approach it in this way, is that for 10 years, Cambodia has agreed to no more damming on the Mekong River. They've managed to stop a number of dams being constructed on the Kunene River in Namibia, and 24 Amazonian lakes have been protected by local communities. So as I said, their best environmental initiatives also have a social side. So in conclusion, greenwashing is rife as it's a very profitable activity and will only become more so due to generational wealth transfer from baby boomers to millennials and Generation Z. Very important to look beyond marketing and research both the investment manager's corporate and investment approach and their real world impact. And it's particularly difficult to evaluate investment approach in the alternative investment sector, such as hedge funds. So it's very important to think about which responsible fund approach is appropriate. And that at that point, I will pause for breath and see if there are any further questions.
Thank you very much, Emily. I think it's rather quiet, but that's absolutely fine. I personally say I'm very happy and I feel grateful for the lively discussion that we've had. I'm also always happy if we can finish a bit earlier because everybody is going into their evening and it's Thursday evening. So at this point, if there are no other questions, if you have any question after digesting all the information, please feel free to contact Emily, Women's Sustainable Finance, or myself directly, and we'll make sure you get the appropriate answer. If it's allowed by Aurum's compliance department, we will share the slides and we will share the recording. The recording will be also given on our own YouTube channel. Thank you, Barbara, for your positive feedback. It's always very nice if we get positive feedback, and the presentation was very insightful, which I personally also thought, Emily. Thank you so much for your input, for your lively discussion, for your lively input, also for the fact that also in Aurum shows that within the hedge fund industry, it's also possible to make a very positive social and ecological impact. For all the people who are listening in, our next event of Women's Sustainable Finance will be on the 18th of November at 6 p.m. And it's a topic which is very much related to the current one that we have. It will be with Desiree Fixler. I don't know if you know her, but she's been in the press internationally quite a lot lately. She used to work for DWS, a German asset manager in New York, where she was made redundant because she asked critical questions about the company's policy, the marketing policy on being sustainable, and it was going on inside the company on sustainability, because these two things didn't match. So we're going to hear from first side inside information on how authentic is a company and how much is marketing on sustainable investment. So very keen to have her as a speaker, and we're very grateful that she volunteered. On the 23rd of November, Louis Aboucher will, with our Women's Sustainable Finance Geneva branch, talk about the holistic integration of ESG. Leaves me to say thank you all very much for attending, for making our work valuable. Emily, I think you're an excellent speaker. I learned a lot. It was very insightful. I'm very grateful. I wish you all a very nice evening. I'm very much looking forward to seeing you at one of our next events. Thank you so much. Have a nice evening. Bye-bye.
Thanks, Edith. Bye.